Hi everyone, my name's PK, and here I have Paritosh Wadhwani, who is a client of the Property Investment Accelerator. He's also a mortgage broker. So in this episode, what we're going to do is like a combination. We're going to go through his journey a little bit. He's owns right now portfolio value, gross portfolio value between $6 to $7 million. So he's done pretty well for himself. I can't, of course, take all credit for that. He's also built and developed properties before as well. He's a mortgage broker right now. Towards the middle and later part of this episode, we'll go through how people can improve their borrowing capacity, whether it's through things like debt recycling or through trust structures. He's going to take us through how he's personally used entity structures to boost or rather preserve his borrowing capacity, and how he's helped many of my clients, many of non-my clients do so as well through trust, etc. So instead of just talking about it theoretically, we have an authority here who's, kind of living and breathing it on a day-to-day basis, both for himself and for others. As we know, property investing and building a property portfolio is as much of a lending or finance game as it is about finding the best property and location. So I think this episode is going to be super useful for you. He's based in Melbourne, very experienced property, I would say, developer and an investor now. So stick around right till the end because it might allow you to boost your borrowing capacity and just get that additional one, two, or more investment properties. Paritosh, thank you so much for making time.
Thanks for inviting me, PK. So just to start my journey, I bought my first property in 2010, brand new unit. In hindsight, I shouldn't have bought, but at that point of time, my wife wanted a brand new place, so the unit was the only thing which I could afford. We then, in 2 years' time, bought a land in North Kellyville, Sydney, and then we built a house. And we sold the unit where we made around $100,000. I needed that funds to start my property development journey, right? So I bought an old house really knocked down in Almington, which is between Parramatta and Ryde in Sydney. And it took me 3 years from start to finish the project because I was uneducated in that field. I didn't know anything. Section 73 stormwater easement and these type of things took me by surprise, wasted some money. But look, at the end of the day, the result was great. I made around $400,000 to $500,000 in 3 years, and I invested similar type of money. So pretty much in 3 years, I made decent return, I would say, right? And then I did these type after obviously I gained a bit of experience about how to buy a property to make sure that these type of hurdles are not there. And I did around 8 to 10 developments in between, right? Um, from a professional point of view, I'm a mortgage broker. And before that, I've worked in Big Four bank as well for 10 to 12 years in the same capacity, commercial home and lending management.
Right.
Right. So yeah, that's my profile. That's my stuff. And I
Amazing.
joined your course, I think, in 2023 November, and I
Uh-huh.
completed the course uh, between 20th of December until 3rd of March. I had nothing to do. It was a pretty quiet time. So every day, 1 or 2 videos, I used to do it. Yeah. And I think the course really helped me in having a structured way about what to look for a property, especially interstate, right? It's pretty easy for me to find a property where I live because I can drive. Maybe it's 1 hour drive. It doesn't really matter. But when you're buying in places like Perth, Gold Coast, Brisbane, you can fly, but how many times will you fly? That's the question, right? So the course really gave me the confidence about how to approach the person. I was a bit hesitant to just pick up a call and say, "Can you inspect the property?" But I think you told, like in your course, you do guide us through that how to approach it, right? Because we have to show what's in there for them as well, not what is there for us only. So it really helped me. And then as a result, I thought that then I bought a property in Gold Coast, two properties in Perth, and I already had an investment property in Sydney, two
Right, right.
investment property in Sydney.
I see the theme a lot of people who have done a lot of development and they make these chunk profits over the course of, let's say, 5 to 10 years. And then I think invariably looking back, they sort of think to themselves, I wish I kept one or two of those properties because let's say, you're based in Sydney, right? If you had, kept one or two of let's say you did a duplex or you built two or three townhouses, if you keep one of those over the next or preceding 10 years, it's gone up like twice, three times, four times. So a lot of people have that regret. And I see a lot of property and developers switching to property investing rather than just developing, or at least doing both of them so that they're building passive income as you go. I know this episode is not necessarily about your property development experience, but I want to ask you, you know, you went through, I suppose, the ordeal of fire. You said you weren't really fully educated, and of course, we all make mistakes in our first one or two properties. For any budding property developers out there that are sort of listening to you, maybe they're also based in Sydney or wherever across Australia, and they hear something like, "Oh, he did it in 2 or 3 years. He put in $500,000 and made $500,000 profit." Like that perks people's ears up. Of course, easier said than done, but for those people who are watching or listening to this right now, what's like your number one piece of advice from all those developments that you've done?
I think be really mindful, know what you are doing, right? Like the first property I bought, I won't say that I was smart. I would say I was lucky in a way, right? Because I bought a property which was sloping backward. So from front to back, it was going backward. That is the worst type of that's the worst type of property you can buy for duplex development, right? I don't know about other state. In Sydney, the water has to flow naturally as per the gravity. So it has to come from back to the front. Might be a bit weird to say, but you can't do that in Sydney, right? Luckily, we got the neighbor to whom we paid $20,000 or $30,000. I can't really remember, but the negotiation started from $200,000.
Oh, wow.
Right now, when he said 200, because he was a developer himself, so he knew what he was doing, right? And he figured out in 2 seconds that I am a brand new person in the industry and I don't have much idea. So he started with 200. Now, can you imagine? I have sold my unit, made $100,000, bought a property, which was an average price property in the area, but someone asking 200 in hard cash, it pretty much gave me a heart attack, right? But then I spoke with few people. I have a mentor as well, who is my mortgage broker mentor. He told me that do ABCD stuff. So I did a survey and all that and figured out that I can use a different exit point from the back property and not from the neighbor's property, which was on the right hand side. And that pretty much saved me, I don't know, 100, $150,000 or more than that, right? Because I would have negotiated 200 to maybe 150 or 100. But so we got lucky in that way, right? So if you are doing it for the first time, try to really know what you are doing. And it's not that easy. So maybe if you have an architect friend or accountant friend or a developer friend, have a chat with them. So that's really, really, really important because I would have all. There are some properties where you can't do a duplex because if there's an easement going on, I didn't know what the easement was. So imagine if there was an easement right in the middle, and I think you will understand more. You can't do any development then, right?
Hmm.
So I was lucky in a way, and I would say that be very mindful to people out there. You
Right.
can lose money and you can make money, but you can really lose big chunk of money as well.
In Brisbane, you can sometimes, I don't know about duplex, but for townhouses, you can have like a pump at the back of the property that takes it to the front near the road, but that adds cost and other approvals, so approval
In Sydney, you can't do
processes.
that. In
Yeah,
Sydney, you
I
can't
don't know
do
if
that.
that's
From
still the case.
2006 or 7, they have stopped doing that. So we used to do it, but from 6 or 7, we have stopped doing that. And it has to be gravity.
Right, right. Very interesting. Well, that's a great example of something that you may not know that you don't know, like you don't know that you don't
Yeah.
know. So definitely for all property investing or developing, be educated before you get into it. But I would say like that's extra emphasized for development. So you kind of you didn't burn your fingers because you still, made a lot of handsome profit, I would say, from that deal, and I'm sure many other deals. Fast forward, you had an ex-banking career, and then you joined, I think you were saying your wife's mortgage broking business, which has been going for more than 15 years, which is pretty cool. And I think on your Zoom name, it's your wife's name, not
Yeah,
your.
I'm a humble employee in her company.
Well, I don't know how you make that work, but kudos for both of you. I'm sure she's very tolerant of you, and maybe vice versa. I don't want to say anything that will get me in trouble, but good for you guys. Um, fa fast forward, and obviously very experienced now, both of you, in mortgage broking. Take me through like when you guys started buying in trust structures for yourself to aid the borrowing capacity story? Like, why did you start and what does it look like for you?
So while we were doing development as well, we were buying the property under the company or the trust structure as per the recommendation from the accountant, right? So we were doing it from day one because at the back of the mind, we always wanted to buy the investment property, but we never got the opportunity around it because everything like something or the other used to come up and we used to invest our funds into there. So we didn't bought the property from for maybe 6, 7, 8 years. We just did development and development, right? And then my mentor told me that my mortgage broker mentor, he's a property developer as well, and he built only townhouses. And he told me that the way you are doing is great. You are making some money, but you've got to keep some properties. You've got to keep some properties. And the way he does it, he do say 6, 7 townhouse development. He will keep two, sell five. He will pay off the loan, have some money in his pocket, and then keep two. And over the period of time, he has got around 20, 25 properties. So that also motivated me. And then I started doing how can I do the same thing, right? And I realized that it will be pretty hard for me to do it in Sydney simply because to buy anything, it will be close to 1 mil, maybe $800,000 or something like that. And the rental would be what, $500, $600 for a really old house, right? So I thought that I can do interstate, but I was extremely hesitant about it. And that's when I joined your course. And then I got the structure and the confidence of doing it. And then I bought a property in Perth. Everyone was buying in Perth, I would say in 2024 or something like that. I bought at a decent time, not the best time or not the worst time. I bought at a decent time. January 2024, I bought it, right? We settled in March or April. And I settled in April, right? And then in June or July, I thought I can buy one more property. And and the good thing which happened that the property grew in value by $150,000. So I didn't have to pay any deposit for the property in Gold Coast because I got the equity out. All these properties are under the trust structure. And I'm planning to buy one more under that structure before I will switch to trust number two.
Right. So you bought three properties under that trust, under that
Yep.
single
Yep.
trust. And for those people who are watching or listening who don't know, let's just start from the basics in terms of that. Why did you choose a trust as opposed to a company, and how is that helping your borrowing capacity?
So look, with the trust structure, so there are few type of trust, but I would just cover the trust which are pretty what I see day to day people using it, right? So there's a family discretionary trust and there's a unit trust. What mainly people use it, right? There are other types of as well, but I haven't seen that many people using it unless and until they have a really, really specific reason and as per the accountant advice, right? The reason why I bought under the trust was I do development on site as well, and I want if I buy under my individual name, then I will exhaust my borrowing power pretty soon, right? Now, the advantage of buying under the trust is that as long as the properties are positive geared, right? So let's say your property rental is close to $100,000 between two or three properties, or maybe one property, right? And the interest expense is, I don't know, 80,000 or 90 or $95,000. These are not the real numbers. I'm just throwing the numbers in there, right? And at the end, after paying some fees to the accountant, council fees, and all that, you made a profit of say $1,000, or let's say you didn't make any profit. But when you will go and buy another property in a different trust, the bank will say that Trust Pty Limited. So let's say my trust is Paritosh Pty. Uh, at trustee for Paritosh Family Trust, right? So bank will say you have a company and it might have a loan under Paritosh Pty Limited. What is that about, right? So we will get the letter from the accountant saying that this entity can take care of all its expenses right? And it can be left aside. So bank won't take that entity loans into consideration when they are calculating your borrowing power, right? So when you will go to trust number two, you can repeat the same thing. Now, depending on your borrowing power, you might buy only one property under the trust, or you might have five or six or seven property under the same trust. In my particular case, I can have around 3 to 4 properties in a single trust.
Right.
The second issue, what people have to be really mindful is about the deposit, right? In my particular case, because I bought at a right time using the data and all that, I did gain the equity in 3 months or 6 months time. Not everyone might do, not everyone will be able to do the same thing. So in order to buy that, you got to have a deposit as well.
Right. Right. And obviously you timed the market really well in Perth, and people can time the market really well. Even, right now as we're recording this episode, there's always a good time to buy. It may not be Perth anymore, it's other places. But the question I often get, Paritosh, is the strategy works on the premise of the trust being self-sufficient, like you
Yeah.
demonstrated using those hypothetical numbers, 100K income, rental income, all expenses end up being less than 100K. For someone putting in 20% deposit, it's not so easy to find properties that are self-sufficient these days. Of course, if you hold a property that yields, let's say, 5.5 to 6.5% after 1 or 2 or 3 years with, rent rises and hopefully interest rate cuts, even if just one or two, they become neutral, they become positive cash flow over time. And of
Yep.
course, in the meantime, people enjoy the capital growth. But in the short term, they may not be positive cash flow. So how does this strategy work? Without doing anything, I really want to make a point as well. And of course, you're on the same page as me. We don't want to take any risks with, any regulatory things. We don't want to like cut corners. We want to do the right thing. So the question often I get is, well, where do I find these properties? Like it's hard to find positive cash flow properties from the outset.
Look, it's pretty hard to find a positive cash flow property all the time unless you really time the market well. But the other way to make it positive is that you can contribute a certain portion into it as well. So let's say you are negative by $10,000, and if your income allow, can you contribute that $10,000 into there to make it neutral? Once it is neutral, the accountant will give you the letter, right? So accountant has to do the right thing by you and by himself as well. And he also like he's given a letter in his letterhead. So he need to be mindful of what he's doing. But this is what you can do it as well. It works same way when someone buys a property in SMSF as well, right? If you want to improve your borrowing power in SMSF and you do have sufficient funds, what people do, they do voluntary contribution into it. So let's say the contribution is 11% or 11.5%, they do contribute, say, $200 or $300 extra into the super for 3 months, which will improve the borrowing power. I'm pretty sure that you would have seen a lot of your clients doing the same thing. So it works exactly same in the trust as well.
Right. Let's go through a real example in a second of perhaps where you've worked with one of my clients to go through this, because I think, going through a practical example that's real and recent will help a lot of people. But I'll just ask one more question because I know the comment section will fill up with this question if I don't ask it. Um, is that contribution, so let's say a property is $5,000 negatively geared and you're topping up your trust, with your own savings, your personal savings, $5,000
Yeah.
every year. So is that like, I'm asking on behalf of everyone, is that like legal? Is that kosher
It's
from the
allowed.
bank's perspective, from an accounting perspective?
It is allowed. It is allowed, and you can do it. I have spoken with the accountant, and that's what he recommended me to do it as well. Because when I bought my first property back, like some time back, which I have sold it under the trust as well, I used to do the same thing as well.
Right, right. And I should say, everyone who's watching or listening, please get your own tax advice and accounting advice and legal advice, especially when it comes to SMSF, et cetera, et cetera. But we're trying to share our own experiences so that at least you can take some inspiration and education and try make it work for your own individual circumstances, which of course we don't know. This is just for general
Yeah,
education.
definitely.
purposes
Yeah.
only. But
So the numbers what we are given is pretty much hypothetical, and even though if even if I will share the experience of a client of mine, right, that situation might be only specific to him. So it's pretty important to do get the own individual advice and do your own due diligence as well before you
right,
do anything of that sort.
right.
So I do work with a lot of your clients as well. The recent example would be I got a call from a customer and he pretty much exhausted his borrowing power. He had one PPOR and then he had one property under his name and one property under the trust as well, right? And he did went to few brokers and the banks directly, and they all said that you can't borrow and stuff like that, right? So what we did for him, uh, bank could only lend him say 300 or $400,000, not more than that. And he wanted to buy something for 550 to 600. He was specifically looking in Townsville, and you know how Townsville was around 8 9 months back. I don't know about it now, but 8 9 months back it was extremely hard to buy in there, right?
It's still
So he
extremely
was
hard to buy. Not that people should necessarily be buying there anymore willy-nilly, but it's still very hard to buy.
So what we did, we did got him a pre-approval, but we didn't went to the big banks. We went to tier two or tier three banks, right?
Hmm.
And we did a loan for him, and he got the pre-approval to buy a property of $650,000 times 80%. For him, funds to complete or the deposit of 20% stamp duty wasn't the issue, right? So it was pretty fine for him to contribute close to 150 to $170,000 because he did have the savings in there, right? And we did a loan for him, and it's almost been around 11 to 12 months now. We did a loan for him, and because when you buy the property, the bank will put a buffer of 3%, right? But when you refinance the property after 12 months, provided that you don't miss any of your payments, you have a good tracking record where you are paying it on time, we can refinance to a major bank as well, and they will use a buffer of 1%. Now, just to make sure that people do understand what the buffer is, if let's say your interest rate is 6%, bank will actually see that whether you can afford to pay at the rate of 9%, not at the rate of 6%, right? But after 1 year of good history and you go back to a major bank, they will calculate whether you can pay at the rate of 7%. So 2% will make a big impact on the borrowing power as well, right? So we took him. Now for 1 year, he was on a really high interest rate. If he would have gone to a major bank, he would be paying interest only under the trust, maybe 6.7, 6.6 or something like that. He was paying 7.5%, right? So he did pay more, but then in this 1 year, he has made an equity of close to 80 to $90,000. And this is not just the random numbers. We have done a valuation on day one. It came the same as the purchase price from the tier two or tier two bank. And now we have done a valuation yesterday and it came $90,000 more.
Okay.
Right. So not only we are refinancing, we will give him extra $5,000 6,000 as well, because that's the limit. You can't get more than that money. So we did help him, right? Now he could have gone and bought a property of say $300,000 or $400,000, but I don't know. I don't think if he would have bought in an area which is not performing as well as that particular area 9 months back, he would have made that much of an equity. So it really helped him, right? And now what we are doing for him, we are doing the refinancing, but at the same time, we are doing a pre-approval to buy another property of close to 550. And this
Right.
time he wants to buy in a metro area.
Right. Right. So the Big Four bank only applied a 1% buffer because they saw that this
Not
mortgage,
all the banks. Not all the banks.
right,
Sorry, not all the banks.
because he had that 1 year of solid, I suppose, payment history. So the buffer was less by this particular Big Four bank that he refinanced to. Therefore, the borrowing capacity, was a positive impact on borrowing capacity. And all of this was done in a trust, like a family,
Everything was done under the
discretionary
trust.
family trust.
It's a discretionary family trust where the trustee is not an individual but a company. So it can be Paritosh Family Trust, trustee for Paritosh Pty Limited.
And he or she, or let's say
It's a
he,
family of two, husband, wife, two kids.
right, right. And so they had to contribute, just like in that example before, they had to contribute something into the trust because the property was slightly negatively geared,
Now
or
he was getting a really good rental. He got in contact with one of the real estate agent and he put the property to some agency, Red Cross or something, and the normal rent would have been around for a property of 650. It was around 600, 650, but he got around 750, 800. So he
right.
was lucky in a way where he wasn't paying anything from his pocket. But I'm saying that there are other customers who do the same thing, contribute $5,000 to $10,000, and then make the trust as neutral, at least if not profitable, and then we can switch on to trust number two, trust number three, trust number four.
And for the clients of mine who are working with you to adopt this strategy, Paritosh, um, like how do you decide, maybe this is an accounting question, I don't know, but how do you decide how many properties you buy in each trust? Like you mentioned you had, what was it, like three?
Three plus
Three?
one approval.
Yeah. So how do you figure that out? Is it based on the total value of the holdings in it, or why not just go one in each trust, or just two, or why not just put everything in one trust?
Again, it will depend on customer to customer, right? Now, the example which I just gave you, he was so between husband and wife, they have a family income of $250,000 with no car loan, no credit card, and these type of things, right? So for him and his PPOR loan, not the value, PPOR loan is only $700,000, and the investment under his individual name is only $350,000, right? So he can buy one or two, maybe one property at least under his name, right? But then if he will buy one property, he will exhaust his borrowing power. That's why he himself came up with the thought, because he did had a meeting with the accountant, that can I buy under the trust, right? What we did extra, that we figured it out that under one trust, instead of going from one trust to trust number two, trust number three, he could afford to have two properties under the same trust. After that, his borrowing will exhaust. So that's when we told him that maybe for trust number two, you go and have a chat with your accountant and have you got funds to complete? Because funds to complete will be very critical here, right? In his particular case, he did make equity from the property. So what we did increase the loan uh, under the trust and got him a deposit, which he will use now to buy the property under trust number two.
So you can use equity from a property in trust one to use as a deposit for property under trust
Yes,
two.
100% we can do it. 100% we can do it.
Got it. Got it.
You got to really check with the accountant that how will it impact your cash flow, how will it impact the profitability or the cash flow of the particular trust. But yes, to answer your question, if let's say we buy a property of $500,000, the loan is 450 or $400,000, and the property will increase the value to 600, you can increase your lending under the trust, and bank will be fine as long as you can service, obviously.
I think it's very important, if people are watching or listening to this and they're thinking about adopting this strategy, this lending strategy, this entity strategy, although a trust isn't technically an entity, but let's say structuring strategy, it's very important to get your property decisions right. You don't if you don't want to be having all these different trusts and then buy off the plan apartment or house and land package that goes down, or in a bad location or something that needs constant work and repairs. You need to follow data and basically hit the bullseye or very close to the bullseye every single time. So you need to be educated because this is not, I don't want to scare people. I don't want to say it's not for the faint-hearted, but it is a more advanced strategy than what most people do. But is it fair to say, Paritosh, that like you're seeing, at least in your business, I know I'm seeing it in people joining the course, more and more people are using this going forward?
So I can tell my experience, right? So before I used to see maybe one or two trust structure a month or maybe 2 months, right? And I'm talking about 2021-ish and all that, right? But from 2023 to 24, I'm seeing pretty much one trust structure a week or maybe two or three structures a week. So people are doing it more often. And
Hmm.
definitely it's not for everyone, right? So I don't ask them to ask every customer of mine to do the same thing, right? It has to really make sense. And first of all, like Do they really want to have 4 to 5 properties? It's very easy to say, I want to have 5 properties, but then you really need a mindset to go and find those 5 properties. How are you going to find it? Are you ready to get educated? Right? Education is the main thing. And when I say education, like maybe join a course. If you don't want to join a course, at least go through the videos. There's so much information. I mean, before joining your course, I went through your videos like crazy. I did spend around half an hour, 1 hour every single day going through the videos, and there's so much information out there. So education is the key to it, right? There's no point
Mm.
of buying off the plan apartment or house and land package, and then that apartment price might never increase, or it might not increase as significantly as if you would have bought, let's say, in regional New South Wales or regional Queensland or somewhere, right? You might buy a property apartment in Sydney, which always be same. There will be strata cost as well. So you got to be really careful, and you really have to have a mindset that you do want to do it and you want to dedicatedly do it.
I think that's a great call out. And just to add to it, you need to have a mindset of being responsible and accountable
Yes.
for your journey. Like, you know, with all due respect to all brokers, you need to be the captain, and they are a very valuable member of the team. As soon as you just send an email to a broker and say, I don't know my situation, you tell me what's best for me, like you're kind
Ah,
of letting go of the power. It needs to be a partnership. And same with the accountant. Don't just say to the accountant, please tell me, should I go with this trust,
ah,
that trust, this or that? You need to understand the pros and cons as they relate to your situation, and you need to make the right decision. And then the same, of course, with your long-term portfolio strategy, suburb selection, etc. Whether you do my course or not, you need to understand this because if you're adopting this tiered, more complex trust type strategy, you need to be across it. Like you need to be, I would say, you don't need to know as much as the mortgage broker or the accountant, but you need to know a lot so you can handle them, you can manage them. It's like imagine if you're the coach and you've got like LeBron James and Kobe Bryant and Michael Jordan. It's like if you don't know how to talk shop, like they're not going to respect you, they're going to run all over you, the team's not going to win maybe. You need to be the gel and make everyone work together. And I think that comes with education, knowing how to do that. It comes with confidence, and obviously confidence comes from knowledge. I don't want to just talk about the positives, though. I think it's important to balance the scales. Paritosh, from your experience and of course your wife's experience as well, what are the downsides or what are the risks of adopting this strategy?
So before I go into it, I just want to share one more example,
Sure,
right?
yeah,
A
go ahead.
customer of mine came to me to figure out the borrowing power. He wasn't my customer. I didn't did a loan for his PPOR or for the investment. Uh, but he do follow you a lot, right? So he did came to me to calculate how much he can borrow, and he wanted to buy under the. He was confused whether he should go under his name or under the trust name, right? What I did to him that look, I can say whatever I want to say, right? But you go out, you don't come to me for the next 2 or 3 weeks. Go out and get yourself educated. What I did for him, I did went into YouTube, got your few videos, send him the link, and I got some other videos as well, right? That go through these videos. It will take time, but don't come to me for the next 2 weeks until you at least go through 3 or 4 videos. So you know what you are doing, right? Because it's very easy to put that you told me to do it, but you got to know that why did I told you? What was my intention behind it? Or what was the accountant intention behind it, right? He did came to me after say 3 weeks or 4 weeks. He wasn't able to go through all the videos in 2 weeks, and he did bought a property under the trust, right? But at least now I can sleep well knowing that he did it. He himself got educated for it, right?
Hmm. I I don't know if it's your experience as well, but like I feel that uh, investors sometimes get FOMO, like they see
Ah,
someone making money and then they're like, forget about all the strategy. Yeah, let's just buy a profit. Let's put some like runs on the board. And then they're like, oh damn, I should have bought it in that structure. Or damn, even though it's made money, the yield is too low or I overpaid for it, whatever the case may be. I always say like, an opening batsman, even in like 50 over cricket. the opening batsman often takes a couple of balls just to see how the ball is shaping, how it's seaming, how green the pitch is. Just observe things, be educated for a few balls, and then you can see, okay, well, there's a half volley, let me smack it through cover for four. Just take the time, your runs will come on the board, but there's no point trying to hit it down the ground for four on the first ball. You might nick it, you might get clean bowled. So just be very careful.
And the thing is that sometimes people do get FOMO because over the barbecue, their friend is saying they have bought four properties or they have bought three properties, and you. So I think everyone is in their own journey. You don't have to compare what other person is doing because look, he might be our best friend or he might be really close to us, but we don't know his financial situation, right?
Mm,
That what type of funds they have, what type of job they are doing. We will know what type of job they are doing, but we won't really know the income level of that, right? So I think everyone should take their own journey and should get their own education at their own pace, right? Now, going back to the trust structure with some negative about it as well. Look, obviously there are some downside of buying under the trust as well. The first downside would be that you will be up for the land tax. Now, depending on which state you are buying, so let's say if you buy New South Wales, you got to pay land tax from $0 to whatever the property value is. And when I say property value, the land tax is calculated only on the land value, and that might not be the market value. It's the value decided by the NSW
yeah.
government, right? So you got to pay land tax from $0. Whereas if you will buy under individual name, I think the exemption is close to $1 million. Apart from your PPOR property, the exemption is close to $1 million. I might be wrong, so don't quote me exactly, but that's what I think it is, right? But then again, if you go and you buy in Perth, I think the exemption is there if you buy under the trust or under the company. Again, don't quote me. It's around 250 to 350, and same in Queensland as well, right?
Mhm.
So let's say you buy a property where the land value only, as per the government of that particular estate, is $600,000. Then you will be up for the land tax, which can be close to $2,500 to $2,000, right? So that's the additional cost you're gonna have, right? You won't be able to get negative gear. Uh, but again, we don't target for negative gearing, but you won't be able to do the negative gearing against your income. The second thing will be that sometime when you go and you buy the property under the trust, there will be additional costs. I think to open the trust, it will cost anywhere from $1,500 to $3,000, which is a one-off cost. And then every year you will have to do your tax return, which can be anywhere from again 1,000 to 2,000 to 2,500, depending on the accountant. And
Mhm.
then if the rental is of a X value, then you might have to lodge your basis and stuff like that. So there's an
Okay.
additional cost associated to it. But I can share my experience, the benefit what I have got, and it might not be for every single person, right? So you got to be really careful. If I would have bought the property under my name, I would have bought maybe three properties or four properties, right? Under the trust, I think I can have around 6 to 7 properties. So let's say I have two extra properties under the trust, right? Just two extra properties, not more, right? Uh, those two extra property in 10 years, let's say I got to pay some fees to the accountant, I will lose on the negative gearing, and I have a loss of say 10,000, hypothetically loss of $10,000, right?
Yeah.
So on two properties, I did a loss of $20,000. For the next 10 years, I had a loss of 20 times 10 equal to say $200,000. And those two properties are valued at 500 each, right? Now, I did bought a great properties, right? But even if you do the inflation at 4% or something, I think I will gain much more than that $200,000, which I've hypothetically lost, right? Makes
Mhm.
sense?
It makes sense. Yeah. It's just a weighing
Right.
scale.
Yeah. So even if those property will increase from 500 to say 600 to say $800,000, which reasonably it should, if you have bought property using data and if you have done your due diligence and if everything is going as per normal, if that property made say $300,000 each, I did benefited $600,000. So I did lost $200,000, but I did got what, around $400,000 extra anyways, right? I can sell one of the property, pay off the other property, and have a rental income without any liability as well. Or I can use that money to pay off my PPO after paying taxes and all that. So yeah. You can do
Right.
all that as well. The
And much
second
of
advantage,
I just
yes,
make
sorry.
one quick point. Much of the ongoing tax costs as well are tax deductible, right? So
Yes.
it's important to know that, there, even though it may not be against your own income, but within the trust, it does offset the income that versus what the trust is earning.
Yeah. I forgot to mention that when I will sell property number one and not property number two, the loss which I have incurred, I can deduct it from the capital gain as well. Isn't it?
Yeah,
You have done it. So, yes.
yeah, yeah,
So we can do it. So, I mean, we are not able to claim the loss every single year, but at the end of 5, 10 years or 15 years, whenever we decide to sell this particular property, we can deduct it. So we are just holding on to the loss until we make a big decision of selling it. I'm not saying you have to sell it, but this is, I think we can do it as well
And
if
this
we
is the
want.
advantage of structuring. Your accountant can give you advice on how to defer losses or et cetera, et cetera. There's much more fluidity, much more that you can do versus just in your own name.
And I can't stress enough. You got to really have a good accountant. Accountant is the key to all this thing, right? I mean, in order to be a successful property investor, you got to get educated, which is definitely number one thing. You got to have a good accountant and you got to have a good broker.
Yeah. Yeah, no, well said. And of course, in the course, we provide these accountants, we provide these brokers. I try to not have a conflict of interest where I refer my own clients, and I have like literally
I do that.
dozens and dozens of broking clients, conveyancer clients, accountant clients. So, it's a little bit weird. I can't refer my own clients because then it's like, why'd you refer that guy and not me? I can't refer 100 people. But, nonetheless, people like Paritosh, who are clients of mine, at least on public forums like this, I can say, okay, whilst it's not a formal referral process, it's, I mean, I'm not getting anything out of it. It's at least, if he's bringing you value, or if I'm bringing you value, or someone else is bringing you value on a different episode, different video, maybe from a different person, at least get on the phone and understand, because the more of these phone calls that you have, this is also how you get educated. Then you start to see who's who in the zoo. Okay, Paritosh told me about this. The other mortgage broker told me about that. Now I'm building my knowledge, and whoever I go with, now I can be well informed and ask the right questions. I think that sort of advice is in the best interest of everyone. I'm just conscious of time, Paritosh, and I know we could probably talk about this for a long time. Um, but maybe some last words. Is there anything that you'd like to say, whether it's about your own journey or developments or this finance structure, this lending strategy, anything that you just want to tell people so that they don't make mistakes or they don't leave money on the table?
I think it's really important to create a good team. It's really important to have a really strong team who will understand your financial situation and will recommend you based on what you are looking to do in the next 5 to 10 years. Right now, there are some simple things which you can do it as well to improve your borrowing power. I won't go through credit cards. Everyone know you shouldn't have credit card and stuff like that. But sometimes that recycling is pretty good as well. Now, just to give one more example of a client, right? He bought a PPOR around 15 years back. The loan was only $300,000. And then he wanted to upgrade himself, where he bought uh, a next PPOR, upgraded house. And the first house was kept as an investment, right? He borrowed $700,000 on the new PPOR. And then he came to us, APW Finance, to get the approval for the third property, right? What we didn't, and he was pretty clear that look, I just want to have one more property. I've got two kids. I want to have a house for myself, and I want to give house to each of my kid, right? We didn't recommended him the trust structure or something, but we did something really simple. We did a debt recycling, right? Where we increase the investment property loan, which was a ex PPOR, from $200,000 to the 80% of the current value, which was close to 650 or something like that, the loan amount, not the property value. And then the funds from there, we transferred that to pay off the PPOR property from $700,000 back to, I think, minus $300,000 or something. So now he can borrow more money to buy an investment property of around $600,000-700,000, right? So we did So we did any rocket science or something. We just did the debt recycling, right? A simple strategy. Before he could afford to get a pre-approval of $400,000, but now he can get a pre-approval of close to five to $600,000, right? And the difference is that the way bank calculate is whatever your investment property is, they will take a negative gearing box in there, right? Now, obviously, if your negative gearing is based on $200,000 as compared to say 650, that will have a huge impact. That the impact in terms of dollar value, it will be close to $1,000, right? Now,
Hmm.
$1,000 is equal to 150 to $160,000 extra borrowing a month. $1,000 a month will equate to that. So we did a simple thing, right? So talk to the broker, tell what you are looking to do in next 5 to 10 years, and it can change, right? But at least what you are looking to do as of today, and then we can have a strategy based on what you are really looking to do. But the main thing is that get yourself educated. I can't stress enough that education is the key in all this exercise, because then you take care, then you are the captain of your own journey. And a broker, accountant, or someone like you, we are just helping them to achieve the thing. But again, the steering wheel of the bet is in their hand.
Right, right. Yeah, no, well said. Like I always say, no one cares about your money as much as you do. You know, you have to
Yeah.
take that ownership, and sometimes it can be scary because you may be new to property investing. That's fine. You know, there's no points for being first out of the line. You take your time, understand it, but because when you do, like that understanding is what will get you the return on investment, not rushing or making foolhardy decisions. No, I think this is great. I mean, already, hopefully, people are seeing how an elite mortgage broker talks versus how maybe another mortgage broker talks, where they would just try to get the lowest interest rate. We haven't even like talked about getting the lowest interest rate because for property investors, like, of course, who doesn't want a lower interest rate? But that is not in your top priority list, right? It's all about multiplying your assets, holding as large of an asset base as you can reasonably afford from a cash flow perspective, because over the short, medium, long term, as all those multiple assets double, triple, compound, that's how true wealth and then afterwards passive income is built. But we covered a lot. You might need to go back and rewatch, re listen a couple of parts of this. It was a lot of value dropped by you, Paritosh. I'm really grateful for your
Thank
time.
you. Can I add one more thing into it?
Okay, yeah, go for it.
Yeah. So when a client comes and they ask that when that I have missed the boat or now it's not a good time to buy the property, I would always say that if you can afford to buy today, today is the best time to buy the property. You just got to pick the right type of property in the right location, right? So it's always the best time to property and always best time to buy the property. And as you say, there's market within markets where you can buy a property and have a great experience like in terms of equity growth or a rental.
I'm actually really I shouldn't say looking forward to it, but if the overall national market starts to decline because of the economy or whatever the case may be, in one sense, I'm kind of looking forward to it because then we'll have really great case studies again on showing, okay, even though GDP is going backwards, these sub-markets, these suburbs have actually performed, beyond 5%, 6%, 7%, double digits, etc. Because I know back in the GFC, Australian house prices fell by about 7% during the period, but then places like Bendigo and others, they performed really well. They continued to rise and people continued to make money. So, yeah, as you said, it's always a good time to buy as long as you know where and how. I'll leave it there, but I'm very grateful for your time, Paritosh. Of course, it's always good to be helping experienced property investors. I think you probably knew much of the course already, but just dialing it in, having everything in one spot really helps. And I'm glad that you're now holding properties because passive income is the name of the game at some point.
Right.
No, no, don't get me wrong, chunk profits, we've all been there, right? It's great, but it's always nice to build an asset.
Anupa is really happy with me holding the property. So yeah, can't complain, right? The boss is happy.
That's what it's all about. And thank you everyone for watching or listening. Hope you got a ton of value. I will tag Paritosh. So his name on the Zoom right now is actually his wife's name. So his name's Paritosh. I'll tag him in the Facebook group in the description as well. I'll leave his name, and so you can reach out to him that way. I highly recommend that you do, as well as so many other brokers. Build your panel of experts that you can refer to. Of course, don't waste anyone's time. Brokers, I always say, are the hardest working people in real estate. They do so much upfront work and then sometimes don't get paid if people don't use them. So respect everyone's time. But there are brokers and then there are brokers if you catch my drift. I do have more than 200 of these types of client interviews on my client results playlist on YouTube. Like I always say, I don't mind if you do my course or not, but at least go through them so you can get educated, inspired, just like you did in today's session. Thank you so much. Share this, hit the subscribe button, give it a like. And once again, thanks, Paritosh.
Thank you.